Schiff. He joins us from Weston, Connecticut. He's the CEO of Euro Pacific Capital and the author of The Real Crash, Peter, which I have to say doesn't sound too promising at first glance, the title of your book. Do you think that we maybe are overdoing the equity market fear?
Well, I think there should be more fear in the bond markets. You know, people are fleeing to the bonds as if there's a safe haven there. But, you know, I think if the currencies are all debased in an effort to, you know, prevent collapse or default, the big losers are the bondholders and people that have cash. I think particularly in the U.S. dollar right now, you've got a lot of flight capital going into treasuries. You know, as bad as things are in Europe, they're actually worse in the United States. And I think the lesson for America when it comes to the European crisis is that we're next.
Why do you say that? Some would argue it's the other way around, that you've already been there and through the housing crisis and subprime, that was kind of when everything was flushed out in the States, and then it shifted to Europe.
Well, it hasn't been flushed out. We've just delayed the pain by taking on additional debt. We are much more indebted now as a nation than we were before the crisis. All we've done is borrow trillions of dollars from the world. We've printed a bunch of money, and we've spent it. But we haven't grown the economy. We've just grown our debt. And we've made our economy worse because we dug ourselves into a deeper hole. And we've got interest rates now at 0%. That's the only reason that we're able to avoid bankruptcy, is because we can finance the debt so cheaply. But remember, a few years ago, Greece was borrowing at record low rates. People were willing to lend Greece money even though they were broke back then. It's just that nobody cared, and then all of a sudden people figured out that the Greeks weren't good for it, and rates went up, and that's when we had a problem. Well, rates are going to go up in America too. It's only a matter of time, and when they do, this whole phony economy that's built on a foundation of cheap money is going to collapse.
Would you agree, David? Do you think we're heading back to the worries in the U.S. after this?
Well, it will happen at some point, and certainly, you know, my U.S. colleagues are very concerned about the so-called fiscal cliff in the U.S. That you know, unless something changes in Washington, we could find that the U.S. economy hits a brick wall basically going into next year. But at the end of the day, we have an independent Federal Reserve that, you know, is basically able to print money and is trying to reflate not just the equity market in the U.S. but also the U.S. economy, and has obviously been fairly successful. And most investors we meet still obviously favour holding U.S. Treasuries over, for example, you know, much paper inside the Eurozone, apart from bonds, you know, German instruments.
Or in the case of today, the French bonds that are being bought up, the Dutch bonds, the Austrian bonds. Peter, where do you see value then? If you don't want to be invested in the bond markets right now, and we're seeing signs that equity market flight is happening too, where do you put your capital?
Well, I want to make the point again that the Fed is not really truly independent in practice. It acts as an arm of the Treasury, unfortunately, and it is going to print a lot of money. That is the danger. What's good about Europe is that Greece can't print money, because if they could, it would make the situation worse. You don't solve problems by printing money. You create bigger problems. But if you understand the problem, yes, you don't want to be in bonds or currencies. You want to own real money that can't be printed, gold, silver. You do want to own equities, but I would stay out of equities in the U.S. or in most of Europe for that matter. I would look towards other countries where they don't have this kind of suicide monetary policy, where they have their fiscal houses in order, or at least more in order than the United States or most of Europe. You know, look to some of the emerging markets, look towards Australia, New Zealand, Scandinavia, even here in North America. You look at Canada, look at Asia, look at places like Singapore and Hong Kong. There are places in the world where you can invest to protect yourself from what I believe is going to be a currency crisis. And, you know, I get into that in my new book, The Real Crash.
Do you think there's any sort of timing on this? At the end of the day, you've got a situation where, you know, the Eurozone could basically break itself apart. And obviously in this environment, US Treasuries still remain, obviously, flight to safety, along with gilts and bunds. I mean, would you advise people now to get out of Treasuries, or just simply wait till the problems in Europe seem to get resolved?
Well, absolutely. Look, there's no safety in U.S. Treasuries. When interest rates go up, we've got to default on those treasuries. We can't pay a market rate of interest, let alone retire the principal. Most of the treasuries that are being bought have very short maturities. We have $5 or $6 trillion coming due in the next year. We can't pay that back. We're counting on our creditors to loan us back the money to repay the debt. This is a Ponzi scheme. And, you know, it's the same situation, as I said, Greece was in. They had no trouble selling their bonds when rates were really low. But the minute people figured out that Greek the Greeks couldn't repay the debt, they didn't want to buy them anymore. The same thing is going to happen. You have a false perception of safety in the Treasury market. It's not safe at all. It's a trap, and it's being set by central banks. The Fed is the biggest buyer. They're buying like 90% of the long-term Treasuries. That's not real demand.
Peter, really interesting. Thank you very much, Peter Schiff, the CEO of Euro Pacific Capital.